Right now, while every single financial channel is arguing about what the Federal Reserve just said, something more interesting is happening one screen over, and almost nobody is talking about it. Gold, the metal that gets all the headlines, all the attention, all the safe haven talk, is basically flat, trading in a tight little range like it's waiting for permission to move. Silver just surged nearly 5% in a matter of days. Now, on its own, a 5% move doesn't sound like breaking news, but here's what should stop you scrolling. Silver made that move before the Fed even opened its mouth. It didn't wait for the announcement. It didn't wait for the press conference. It moved first, like it already knew something the rest of the market hadn't priced in yet. That's not normal. And when something abnormal happens in a market this large, this liquid, and this closely watched, it's worth asking the uncomfortable question, what does silver know that gold doesn't yet? By the end of this video, you're going to understand a signal that 95% of retail investors never even look at. You're going to understand why silver behaves completely differently from gold, even though people lump them together as precious metals. And you're going to walk away with a simple framework you can actually use going forward. Not a prediction, a framework. Let's get into it. If you're new here, welcome to Currency Arc Insight. The channel exists for one reason, to help you understand what's actually moving gold and silver without the noise, without the hype, and without pretending anyone can predict the market with certainty. If that's useful to you, stick around and consider subscribing. Now let's dig in. Let's slow down and actually look at the charts, because the numbers here tell a story on their own. Gold has been trading in a narrow band, roughly $4,000 to $4,100 an ounce, for the better part of 2 weeks. Every time it pushes toward the top of that range, it gets sold. Every time it dips toward the bottom, it gets bought. That's not a trending market. That's a market holding its breath. Silver did something completely different. It broke out of a similar consolidation and pushed from the low 50s all the way up toward $58 an ounce, testing resistance levels it hadn't touched in a meaningful stretch of time. Here's the detail that should really catch your attention. This move in silver happened ahead of the Fed's decision, not after it. Most metals, gold included, tend to sit still before a major Fed announcement and then react once the news is public. Silver didn't wait around. It moved on its own timeline. Think about what that actually implies for a second. In markets, when an asset moves before the news that's supposed to be driving prices, one of two things is usually happening. Either the move is pure noise, random positioning that means nothing, or bigger, better informed capital is already acting on information or analysis the rest of the market hasn't caught on to yet. I'm not going to tell you it's definitely the second one, but I am going to show you why there's a real data-backed reason to think it might be. And it has almost nothing to do with the Fed at all. And here's something worth pointing out before we move on. This divergence happened during a week absolutely packed with reasons for gold to be the star of the show. A divided Federal Reserve, a re-escalating conflict in the Middle East, renewed pressure around the Strait of Hormuz. Every single one of those headlines is textbook buy gold material. And yet, gold shrugged, silver ran. If you only watched the mainstream coverage this week, you'd have no idea that was even happening, because almost all of it was pointed squarely at the Fed decision, not at the metal quietly outperforming underneath it. This isn't the first time silver has done this. And understanding the history here is what separates someone who just reacts to a headline from someone who actually understands the metal. Go back to 2011. Silver went from around $18 an ounce to nearly $50 in the span of about 8 months, a move so violent it made headlines for weeks. Go back further to the late 1970s and the Hunt brothers' attempt to corner the silver market. An entirely different cause, but the same underlying pattern. Silver moving in outsized, explosive bursts relative to gold, then giving a huge chunk of it back just as fast. Silver has always had this personality. It's the metal that sits quietly for long stretches, almost forgotten, and then moves faster and harder than gold when it finally does move. Traders even have a name for this behavior. Silver is gold on leverage. Same general direction, same general story, but amplified in both directions. So when I see silver breaking out ahead of gold right now, my first instinct isn't excitement. It's curiosity, because this is a pattern with a long history. And understanding why it happens today requires looking at something most gold-focused investors completely ignore, what silver is actually used for. Here's the concept that changes everything, and it's genuinely the most important thing in this entire video. Gold and silver are not the same kind of asset, even though we talk about them like they are. Gold is almost entirely a monetary and store of value asset. Central banks hold it, investors hold it as a hedge. A small amount goes into jewelry and electronics, but overwhelmingly, gold's price is driven by fear, inflation expectations, currency strength, and interest rates. It's a financial asset wearing a shiny metal costume. Silver lives a double life. Yes, it has that same monetary safe haven identity. Investors buy silver coins and bars for the same reasons they buy gold. But silver also has a massive industrial identity that gold simply doesn't have. It's used in solar panel manufacturing. It's used in electric vehicle components. It's in your phone, your laptop, medical devices, water purification systems. Silver is one of the best electrical conductors on the planet, and modern technology runs on it in ways most people never think about. This dual identity is exactly why silver can suddenly outperform gold. When industrial demand is strong, think renewable energy expansion, EV production ramping up, that pulls on the exact same limited physical supply that investors are also trying to buy for safe haven reasons. Gold doesn't have that second source of demand pulling on it. Silver does. And that leads us to the actual mechanical reason behind what's happening right now. According to the Silver Institute's most recent World Silver Survey, the global silver market has been running a structural supply deficit, meaning the world is consuming significantly more silver every year than is being newly mined and recycled combined. Let that sink in for a second, because this is not a one-year blip. This is a multi-year pattern. Solar panel demand alone has grown so fast that it's absorbing a meaningful chunk of annual mine supply on its own, and that's before you count electronics, EVs, and traditional investment demand. Here's why this matters so much for how silver behaves in the market. A structural deficit doesn't create a straight-line price increase. It creates a coiled spring, because the deficit builds quietly month after month without necessarily showing up in a dramatic price move, right up until some catalyst hits. A Fed decision, a weak dollar, a safe haven bid from geopolitical stress, any spark at all. And when that spark hits a market that's already tight on supply, the price doesn't just move, it jumps, because there isn't enough available metal sitting around to absorb a sudden wave of buying without the price moving hard to ration that limited supply. That's the mechanical answer to our original question. Silver isn't moving 5% in days because of magic, or manipulation, or some secret information only insiders have. It's moving because the floor underneath the price has been quietly rising for a long time, through structural scarcity, and this week's Fed uncertainty, combined with ongoing geopolitical stress, and was simply the spark that lit a fuse that had already been sitting there. It's also worth understanding why this deficit isn't likely to disappear overnight. Bringing new silver supply online isn't like flipping a switch. Most silver historically isn't even mined as the primary product. A huge share comes as a byproduct of mining for other metals, like copper, lead, and zinc. That means silver supply doesn't automatically respond to silver's own price. A mining company doesn't just decide to produce more silver because the price went up. They're constrained by decisions made around entirely different metals. On the demand side, meanwhile, solar installation targets and EV production plans are already locked in for years ahead in many countries. So you have a supply side that's slow and indirect, and a demand side that's already committed and growing. That combination is exactly the kind of setup that produces multi-year structural deficits, rather than a temporary one-season shortage. Now let's talk about the single most useful tool for understanding this relationship, the gold to silver ratio. It's a simple calculation. Take the current price of gold, divide it by the current price of silver, and you get a number. That number tells you how many ounces of silver it takes to equal the value of 1 ounce of gold. Historically, that ratio has swung in a wide range, roughly 40 on the low end, up to 100 or more on the high end, during periods when silver is deeply out of favor relative to gold. When the ratio is high, silver is considered cheap relative to its historical relationship with gold. When that ratio starts compressing quickly, which is exactly what's happening right now as silver outruns gold, it usually means the market is in the process of correcting an imbalance. Here's the psychological trap I want you to really understand, because this is where most retail investors lose money on this exact trade. Gold gets 90% of the attention because it feels safer, more familiar, more grown up. Silver gets almost completely ignored by mainstream financial media, right up until it moves so fast and so hard that everyone notices at once. And by the time everyone notices, the easiest, most asymmetric part of the move has usually already happened. The gold-silver ratio is how you get ahead of that. It's not about predicting the future. It's about recognizing in real time when the relationship between these two metals is shifting, instead of waiting for the shift to become the top headline on every finance channel, including this one. I want to be really honest with you in this section, because this is the part that actually matters for your money, not just your understanding. Most investors don't buy silver during a move like this. They buy it after it's already run, after it's the top trending topic, after their coworker mentions it at lunch, after the excitement is loud, obvious, and impossible to miss. And historically, that's often close to the point where the easy money has already been made and the risk of a sharp pullback is highest. The investors who actually benefit from a setup like this aren't the ones who react fastest to the headline. They're the ones who understood the mechanism, the structural deficit, the ratio compression, the dual industrial monetary identity, before the price move made it obvious to everyone else. I want to be clear about something, because I take this seriously. This is not me telling you silver is guaranteed to keep going up. It's not me telling you to go buy it right now because a YouTube video said so. That would be irresponsible, and frankly nobody, including me, can predict short-term price moves with certainty. What I can do is show you the actual mechanism driving this move, so that whatever decision you make, you're making it based on understanding rather than emotion or FOMO. That distinction, reacting to the reason behind a price move instead of just the price move itself, is genuinely the difference between an investor and a gambler. I'll give you a simple gut check you can run on yourself anytime you feel the pull to chase a fast-moving asset. Ask, if this price move reversed 5% tomorrow, would I still believe in the underlying reason I bought it? If your answer is yes, if the structural deficit, the industrial demand growth, the ratio compression, all still make sense to you regardless of tomorrow's candle, then you're investing based on a thesis. If your answer is no, and the only reason you'd still feel good is if the price kept going up, that's a sign you're reacting to the chart, not the fundamentals underneath it. Neither approach makes you a bad investor, but only one of them tends to hold up when the inevitable volatility hits. And with silver, it always eventually does. Now, I'd be doing you a real disservice if I only showed you one side of this. So let's talk honestly about the risks. Silver is significantly more volatile than gold. It always has been, and that cuts both ways. A move that goes up 5% in a matter of days can just as easily reverse 8 or 10% if the conditions change. Here are the 3 things that could unwind this thesis. First, if this rally turns out to be short-term speculative positioning, traders piling in on momentum rather than the structural deficit story actually playing out, it can reverse just as fast as it built, sometimes faster. Second, if we see a broader economic slowdown, industrial demand for silver and electronics, EVs, and solar can soften meaningfully. Remember, that industrial demand is half of what makes silver different from gold. If it weakens, silver loses one of its 2 engines. Third, and maybe most importantly, if the Federal Reserve surprises markets with a genuinely hawkish move in September, remember, 3 voting members already wanted a hike at the last meeting. Rising real interest rates tend to hit silver harder than gold precisely because of that added volatility. So this is not a silver only goes up from here video. And if any channel tells you that with total certainty, I'd encourage you to be skeptical. This is a here's why the move is happening, and here's exactly what would prove the thesis wrong video. That distinction matters more than almost anything else I'll tell you today. Let me put this in terms that make it easier to hold on to, because we've covered a lot of ground. Think of the silver market like a small reservoir that feeds 2 different towns. One town only draws water when there's a drought. That's investment demand, showing up mainly during fear or uncertainty, similar to how people buy gold. The other town draws water every single day, rain or shine, because its factories depend on it. That's industrial demand, the solar panels, the EVs, the electronics that need silver no matter what the headlines say. For years, that reservoir has been slowly draining because both towns together have been drawing more than the rain, the mining supply, puts back in. Most of the time, the water level dropping doesn't make news. It's slow. It's boring. Nobody covers a reservoir quietly losing an inch a month. But the moment anything triggers extra demand, a scare, a rumor, a genuine shortage somewhere, the reservoir doesn't have the buffer it used to. The response is fast and sharp because there's less room left to absorb the shock. That's silver right now. The shock this week was Fed uncertainty layered on top of renewed geopolitical stress. But the reason the reaction was so outsized compared to gold is that the reservoir, the structural deficit, has been quietly shrinking for years. Gold doesn't have that daily draw industrial town pulling on its reservoir. Silver does. That's the entire difference in one image. So let's bring this together into something you can actually use, starting today. Here are the 3 things I'm personally watching. Not advice, just the framework I use to make sense of this myself. Number 1, the gold-silver ratio. Is it continuing to compress, confirming silver's outperformance, or is it starting to stabilize and reverse? That single number tells you more than almost any headline will. Number 2, resistance around the high 50s in silver. Does the price break through that level with real conviction and volume, or does it stall out and roll over? That's the technical confirmation, or rejection, of everything we just talked about. Number 3, September's Federal Reserve decision. Given that 3 voting members already wanted a hike at the last meeting, this isn't a formality anymore. A genuine hike changes the real interest rate environment for both metals, and silver, given its higher volatility, would likely feel that shift the hardest. Track those 3 things, and you'll understand where this story is heading long before it becomes the obvious, overhyped headline everywhere else. One last thought before we wrap up. None of these 3 signals require you to check the market every hour, and none of them require any special access or insider tools. The gold-silver ratio is public. The resistance levels are visible on any free charting site. The Fed's calendar is published months in advance. The edge here isn't access to secret information. It's simply paying attention to the right things instead of the loudest things. That's a skill anyone watching this can build over time, and honestly, it's the entire reason this channel exists. Here's the honest takeaway. Silver outperforming gold right now isn't random, and it isn't magic. It's the visible result of a structural supply deficit meeting a moment of genuine uncertainty. That doesn't make it a guaranteed trade. It makes it a story worth understanding, so that when you make your own decisions, you're doing it with real information instead of reacting to noise. If this helped you see the bigger picture behind today's headlines, do me a favor and hit subscribe. I break down moves like this as they're actually happening, not weeks later once everyone else has already caught up. And if you want to understand the other major thread connecting to all of this, the Iran conflict and exactly how it feeds into gold prices through the oil market, that video is right here, and I think you'll find it just as useful as this one.